So you're telling me that information technology is over 32.90%. So for me, what that tells me is that the S&P 500 is not going up without technology participating. What's going on, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode. Now, in today's episode, we're going to be talking about ticker symbol XLK. And XLK is the technology ETF of the S&P 500. And XLK tracks all of the technology companies that are in the S&P 500. XLK is an ETF that has experienced a 20% annualized return over a 10-year period. And I believe that it's the top index fund that you should be investing in as a long-term investor over the long term because of how technology is positioned within the S&P 500 and also throughout the economy. I'm going to break down XLK and compare it to the S&P 500 to see the similarities and the differences and see why XLK is probably one you should have overweight in your portfolio. Let's get right into it. Okay, so you can find this information at ssga.com. State Street Global Advisors actually manages this particular fund. And again, as it says right here, the Technology Select Sector Spider Fund seeks to provide investment results that before expenses correspond generally to the price and yield performance of the Technology Select Sector Index. The index seeks to provide an effective representation of the technology sector of the S&P 500. Now, what's important about this sector? Let's go ahead and get into the top holdings here. Now, if you look into the top 10, you've got Apple, you've got Nvidia, you've got Microsoft. Those are your top three. You've got Broadcom, Salesforce, Oracle, Cisco Systems, ServiceNow, Accenture, and Advanced Micro Devices. I just talked about them last week. Now, this ETF has been doing some shuffling over the last few years, and Apple and Microsoft used to be the top two in this ETF for a long period of time. They each had at least 20% of the weighting, but now things have changed, things have shifted. Apple went down, Nvidia went up. Now Apple's on top. Apple's top at 14.71%. Nvidia's got 14.56%, and Microsoft's got 12.64%. But no other company in the ETF has more than 6%. So it's overweight these three companies. These three companies make over 40% of the fund holdings. And so that's very, very important to understand. Why is that important to understand? Because this is a market cap weighted ETF. So when you look at it, all three of these companies are trillion-dollar companies. So it makes sense for them to be the top ones in this particular ETF. There's no other companies besides these three that have trillion-dollar market caps. So I want to show you the performance of this particular ETF. And this particular performance is as of November 30th, 2024. So it's a little bit dated, but it's close enough for what we're trying to show right here. 1-year return, 27.13%. 3-year return, 12.45%. 5-year return, 22.66%. And 10-year return, 20.11%. So this particular ETF has been in inception since December of 1998. So it has withstood the test of time. And this particular ETF generates great returns that actually outperform the market. And we're going to show you exactly what this ETF is comprised of in terms of industry allocation and the comparison with the benchmark. So again, the industry allocation that I was just talking about, look at it. You've got 35.22% semiconductors and semiconductor equipment, 34.22% software, 16.66% technology, hardware, storage, and peripherals, 6% IT services, and 4.82% communication equipment, with a little bit of 3.08% of electronic equipment, instruments, and components. So if we look at the industry allocation and where is the weighting, where is the money, we're talking about almost 70% of the ETF is positioned into areas of the technology industry that have the most growth. Technology, data centers, AI. That is exactly what is growing, and that's what is providing the most value right now when we're talking about technology. It's very, very important to understand. We want to have our money fixated into places that have the ability to grow over 5 year, 10 year, and even longer time horizon, because we should be long-term investors at the end of the day. Now, I want to shift gears to the top holdings of the S&P 500. Now, the S&P 500 is our benchmark. Money managers are graded against the S&P 500. It's the granddaddy of them all, right? But the top three holdings are unchanged in the S&P 500 from what we have in XLK. You've got Apple, you've got Nvidia, and you've got Microsoft. They're the top three. Together, over 20% of the entire market. We're talking about the entire market. We're not talking about just the index. We're talking about these three companies are 20% of the entire market, taking all 11 sectors into consideration. Now, when you're investing into XLK, you don't have exposure to Amazon. You don't have exposure to Meta. You don't have exposure to Alphabet. You don't have exposure to Tesla, Berkshire, other companies. But that's the trade-off at the end of the day, because the ETF still has solid returns. But I'm really about to show you why I think XLK should be that top index fund in your portfolio. Okay, so here's the sector allocation of the S&P 500. And if we look at the sector allocation, there's 11 sectors in the S&P. 32.90% is information technology. I'm going to repeat that again. 32.90% is information technology. The next highest is financials with 13.42%. Consumer discretionary third, 11.28%, and communication services 9.56%. So you're telling me that information technology is over 32.90%. So for me, what that tells me is that the S&P 500 is not going up without technology participating. If the market happens to have a down year and stocks tend to not perform as well, the S&P 500 is going to be down, but also information technology is going to be down too. There's not going to be a situation to where information technology is negative, but the S&P 500 is positive. Even if we had a situation to where energy or real estate or utilities or materials or smaller sectors were outperforming, for example, these sectors do not make up a big enough weighting to be able to bring the broader index up. So why not be overweight information technology in the same way that the S&P 500 is overweight in the information technology? There's nothing wrong with having diversification and having the S&P 500 on your team, but XLK needs to be above and beyond that star player, the one who's really truly making the most money on your team. And lastly, here is the performance. This is the performance that we're talking about. 1 year, 33.70%. 3 year, 11.3%. 15 year, 15.61%. And 10 year, 13.20%. So over longer periods of time, the S&P 500 is underperforming technology on a pretty large scale. Now, you may look at this and you may say, well, technology has been able to benefit from a long bull market, right? The technology has been able to benefit. But let's just ask ourselves the question, how do we get to a situation to where technology is not 32% of the S&P 500? When is that going to happen? When will that weighting change? I will argue with you that weighting will not change. I would argue that the way that we've got things set up is almost impossible for it to change. So consider these particular returns. We understand that XLK is outperforming it over a 10-year time span. What could the difference in those particular returns over a long period of time span, what kind of difference could that make in your portfolio? I would argue a pretty large difference. So just for illustration purposes, I wanted to bring up this compound interest calculator. Now, I'm really not one of those people that like to talk about if you invested $10,000 10 years ago, where would it be? Like, I honestly do not like doing this, but just for illustration purposes, in terms of what I'm trying to explain to you, I think that we need to understand what compound interest is, the power of it, and what it could do if you have long-term investment. So we've got a blue line, we've got a red line, and we've got a green line. Now, this is just assuming that you started with $10,000. You put $10,000 in, you didn't put any more money in, and you got a 20% return, 20% annualized return. You got a 13% annualized return, which is what we, on average, we got for the S&P 500 over 10 years. And then the 27% is above and beyond. Like 27%, that's something different. Now, if you want to invest in something like AMD or Nvidia or Microsoft or Apple, Tesla, you may be able to do something like that. But we're just talking about XLK and the S&P 500. So at the end of the 10 years, you would have $61,917.36 being an XLK versus a $33,945.67. So we're talking about almost double the amount of compound interest by investing into XLK. Now, again, this is not saying that you should just disregard the S&P 500, or you shouldn't even have it at all. I invest into the S&P 500 in my own 401k. But what I'm saying is that XLK should arguably be overweight in your portfolio if you have a long-term time horizon, if you don't need the money anytime soon. Let XLK cook. Let it be in that slow cooker. And I promise you the compound interests are going to show themselves and you're going to be able to have a very nice result. Okay, y'all. So last but not least, let's go ahead and get into the charts. Now, you know I like to leave the charts for last after we have gotten into the meat and the potato. So here's the daily chart of XLK, and XLK had a negative day today. The market was down 2% down, due to some economic data that the market did not like. But nevertheless, right now XLK is hovering around the 50-day moving average, well above the 200-day moving average. And what we need to understand is that XLK has actually been moving sideways. It's been moving sideways for the last month or so, maybe even longer than that. And the stock hasn't made a new high, hasn't made a new closing high in some time. You know, we've hit $241.88 back in December. We hit 241.65. We've hit 241.45. We've hit 241.57, and we've hit 241.06. Those were all, we hit 241 on multiple days throughout the last month, but we haven't been able to break out. Well, I would argue that XLK may be consolidating for a move higher. Pull back to the 50-day moving average, I believe, is a good thing, and it's a good area for us to buy. Even if we look at XLK and maybe moving sideways right now and hasn't been making a whole lot of, new all-time highs, if we just take a look back and just look at the 5-year time period, what has XLK been doing? XLK has been making series of higher highs and higher lows. We go back to March of 2020, the stock is continuing to make higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, either following along the 50-week moving average, or sometimes briefly coming down to this 200-week moving average, which have shown to be very, very good buying opportunities for the security. But buying the security over and over, dollar cost averaging into it, buying it every single month, that's something that I do. I buy it every single month, And I would also entertain that you do it as well, because it's something that's very, very important for you to have in your portfolio. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Let me know what you think about ticker symbol XLK, the technology ETF of the S&P 500. Again, I'm not telling you to disregard the S&P 500, because I buy the S&P 500 myself in my 401k every 2 weeks. But this is what I want you to understand. You should be overweight XLK because of the outperformance potential, A, the outperformance potential of technology, and B, the sector allocation. XLK technology being 32% of the S&P 500, with the next largest being just 13%. So take that into perspective as you're building your portfolio out and making your selections with your ETFs. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.